So the next one, profit and loss statement, very important for us. We look at total revenue. Sometimes people don't understand what means total revenue, and it's difficult because banks they don't sell really anything, but they sell loans. Okay, how much loans they sell. So total revenue may be considered like that. But also if they do trading activity, again, there is no revenue here. So that's why when you look at Yahoo Finance, that's from Yahoo Finance, it doesn't show you specific about that, and you go again to sec filing in order to get this precise information where the revenue you coming from. Okay, then the next, of course, a very important part, we're looking at expenses. Again, Yahoo Finance is putting like selling, general, and administrative. uh, Banks usually they name it in different non-interest expenses, so nothing related to interest, because there are like cost of revenue, which when they borrow money from somebody, take deposits, and they pay them some interest, so it would be related to interest expense, and then non-interest expense. Now look at our banks. Commonwealth Bank, huge buildings, right? It's quite a huge cost to pay for those buildings, salaries, and etc., etc. And that comes here, and it's nothing related. So if they don't sell any mortgages or don't sell any loans, they still have to pay all these expenses. Okay, so we understand it's not related to amount of business they generate. Okay, so that's why it's important for. Now, when we go to value line, we can see it in a bit different way. So we can see here uh, now non-interest net interest income. Okay, we can see 45 billion here, and then we can see non-interest income. Okay, so about 40 billion. So we can see that net interest income is bigger part of the business than non-interest part of the business. And by looking just here, we understand that this bank is mixed, because we see that uh, that's not their core business of getting interest from loans, right? And I'm going to show you another bank, a smaller bank, and that would be about 80%, whereas here it's about maybe 55, 52% to non-interest income. And then we see non-interest expenses. So those expenses which are exactly what I just told you, that support of premises, all these buildings, and etc., 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 salaries, and that's we can see that 49 billion here. Right, so it's huge amount, and there is a performance ratio which we're going to use, and when we divide non-interest expenses by total income, total revenue which bank creates, and we can see the percentage. And we're trying to see that it's less than 50%. Okay, and then we can see net profit is 21 billion. Okay, and that's all the returns which we were talking just right now. Okay, and of course, one of the like for us easy to understand is pricing ratio, and we can see that right now pricing ratio for Wells Fargo is about 11. And let's have a look at Spreadsheet. So, by the way, when I analyze this company using TAC and Spreadsheet, so we got 38 points by quality, and we got 39 points by undervaluing. So it's not 4 by 4 company, it's 3 by 3, but it's pretty strong company. And if we look for quality, it's losing money on the industry rank. It's smaller. It's one thing. Then timeliness, it's not perfect for that, and but it's good safety, and also the debt, it's losing on debt. But we understand that debt is just a part of the business for banks. You won't find banks which have low debt. Okay, less than 30%, it's impossible. Just all banks they have high level of debt. Okay, so you have to accept it. So if we change these numbers, we already probably get here 4, so a good quality company. So that's why Warren Buffett chose it, because he considers it to be strong, stable company which made money even when the like in 2008, a lot of banks they had huge losses, and we're going to look at some of these reports right now as well. Okay, from price perspective, it's 39, so it's not perfectly undervalued. as we can see. And if the price will go, let's have a look, for example, at $40 or 44, for example, that's where it becomes below our threshold. So that's where we want to buy. And if we look at technical analysis, you will see that as well. So okay, at the moment it's 48.53. So that's the price. That's at 39. So at the moment it's not great, but only last week or 2 weeks ago it was in position where you could enter a position, maybe a bit longer than 2 weeks, but yes, that's earnings would be 14th of October. So before that, it's safe territory. So if you buy, for example, a trade it, so it's kind of pretty safe in this particular case. And earnings are always a bit scary. Now, okay, coming back to price earning ratio, we can see that's the last 5 years of price earning ratio. We can see the lowest was 9.8 and the highest was 13.2. So that's where it's moves from to. Yeah, so it's average annually. At the moment, it's 11.8. So it's above average, right? And it's, I'd say it's closer to the highest point than to lowest point. Now we will be looking when it's the lower, at least the lower than average. Okay, so that's good for us. Now, if we look and calculate price earning ratio in different ways, so for example, uh, these are tops, so 5 year highs. Okay, we can see that the price here reached $34, 36, etc., etc., right? And that's the lowest during the same year. So we can see from 22 to 34. That's the fluctuations of the prices was, and the earnings for that particular year was $2.82, and that's exactly the same. So what we do, we can calculate price earning ratio on that particular year because that's average on the top we look. And here, if you take, for example, 22 and divide by 2.8, you will receive about probably price earning ratio of 8. So it's low. But then here it was 34 divided by 22.8, you will probably get about 13. So, and that's why when you add them together, it becomes 10 on that particular year. For us, it's more important how low it can go. So what we did, we added all income which we had during the last 5 years, and we received in average, it was making $3.6 annually. And then in average, the lowest price was $35. And in average, the highest price was $46. So what we did, we divided highest price by the earnings, average earnings, and we got the highest average price earning ratio, which become 12.6, which is higher than current, right? And then we took the lowest average price in like earnings, sorry, sale price of the share, and then divided by the earnings, and we got the lowest average price in ratio was 9.6. So why do we need this number? If we consider that sometimes in the future, Wells Fargo is going to be between these pricing in ratios, we just need to know how much money is going to make. And there are two things. We look at value line and we can see that projected uh, earnings per share within the next 5 years, 3 to 5 years, is $5.25. And you remember where it take, right? I hope you remember. And if not, I'll show you. So what we do, they take, okay, in the best case scenario, what is going to happen? If Wells Fargo is right and they're going to make this money, and at some point, the pricing ratio would be around 12.62, right? So in this case, the price of this particular share can go and reach $66. That would be assumption based on historical statistic, right? So the highest price we can see $66. Now, the next thing what we do, we say, okay, let's look conservative. And in a worst case scenario, in a worst case scenario, that price earning ratio is 9.66. And we're not going to look earnings which they project. We're taking earnings which already exist last year. Okay, if earnings are this year smaller than last year, we need to take new earnings here, and then we multiply by that, and we come out with number of 40. So, and now we understand that the price can move from 40 to 66. In the worst case scenario, it would be 40. In the best case scenario, it would be 66 based on our like uh, analysis, okay, our formula. So then we divide it by three areas, and we can see that equal areas. So we will buy between 40 and 48. We will hold between 48 and 57, and we'll consider to sell already after 57. So that's would be, and at the moment the price is 48, 56, 53. Okay, it's just under the highest buy price. So that's why I would personally prefer not to buy this company because it's already closed at hold position, but wait until it pulls back down. So always try to be patient in the market and it will give you much higher return. So if it goes to $40 level or even less, that would be the perfect opportunity. Of course, you use here technical analysis and you decide what level. And we're going to look at technicals. Maybe it never goes to $40. Never, but maybe it goes to $44, but it would be much better than 48 because it would be 10% below the current price. Okay, and again, here we get 1 point because we're trying to look at reward to risk ratio 3 times at least. And here we can see that the return upside down we have $17 and a downside we have $8. So it's like 2 times only more. Okay, and in our preference that the higher this ratio, the better for us. Okay, because we have higher return than possible risk. Okay, let's go back to our slides, and now we can see that price earning ratio at the moment is not the best. It's above average. They expect that it goes to 14. I will ask the question here. Why do they think that it's going to be 14? If historically, okay, sometime in 2008 it was 42, but it's because the earnings would drop down significantly and the price probably didn't follow that quick. Okay, and it was like 14 only before 2008. So I don't believe this number. Like personally, I wouldn't believe, and especially when I look at other banks and I can see them below that level. Okay, so that's the thing about it. Okay, when we look at profit and loss statement, first of all, we look at interest income and non-interest income, and then we see the difference between them. So if it is a retail bank, we need to expect that interest income will be much, much higher. If it is investment bank purely, we probably get non-interest income much higher. If it is a mixed bank, so there would be like different variation, depends on the size of their activities. Okay. Another, if it is interest income, we need to know also net interest margin, and the bigger this margin, the better for us. And of course, we look at size of dividends because dividends is what you get. And for example, Australian banks they pay more interest than if you go to US banks, and Russian banks probably pay much more. Like uh, last year, you could get up to 16% in some banks. Huge. Okay, dividends is smaller. Yes, sorry, Alexei. Yes, dividends is much less. But we're going to look now at one of the bank, and it pays 8% dividends. It's US bank, but it's in Australia present as well. So ratios, what kind of ratios we can use here? Return on equity, usually around 10. Okay, in majority of banks it can move from 8 to 12, and for us the highest is better. Okay, we understand that. Now return on total assets, uh, better if it is above 1. Okay, in I showed you that in Wells Fargo it's 1.2 right now. In some banks it's below. So it's if we take total assets, all assets, how much they are making. And remember, in total assets, we include goodwill. And in total assets, we include all the buildings. And you probably understand if they have these huge buildings, these buildings, they don't generate any revenue because it's nothing to do with income. So they don't rent them right out. They just use them. So that's why it's very, very important. For example, Commonwealth Bank of Australia, they um, kind of pay money for this park, close to Darling Harbor, and that's their assets probably, that's their land. But I doubt that shareholders get any money out of it at all, right? So it's kind of extra activities which banks do. Now, efficiency ratio. That's why I was telling you that when you take non-interest expenses and you divide by total revenue, And of course, if it is below 50, so the smaller non-interest expenses, the better for us. Okay, and that's why a lot of people is saying, "Oh, cut bankers' salaries and etc. etc." Because if they cut it, this level, this size of the formula would be smaller, and the proportion would be better in our favor. If it is above 70, it's red flag. Pay attention because it means that whatever bank is making in generating, it pays back to their expenses. Okay, try to keep an eye. P/E ratio. We look at both historical, and that's what we just did. Okay, and within industry. So we have to compare price earning ratio within industry. Remember when we look at last time we looked at what company? UTHR, right? And the price earning ratio was 11 at that stage, and we considered it's quite low. And the reason for that was that similar type of companies in the same industry have price earning ratio around 18, whereas UTHR had only 11, right? Whereas here, if we look at banks industry, price earning ratio in general much smaller because people understand the risks which bank have. So banks they make money when everything is good, and when economy is going bad, banks in a bad shape as well. Okay. Okay, and then we look at PEG, price earning growth ratio. It's better if it is below. Now, what do we do? Imagine that some people say, "Oh, this company has price earning ratio is 18. It's quite high, and I'm not going to invest." But if the company has earnings growth of 30% or 50%, it would be quite low because next year company will be 1.5 times higher and the earnings would be 1.5 times higher. So always trying to look at price earning divided by growth ratio, and it is better for us if it is below 1. Okay, and that's these two important points. Okay, that's two parts. We analyzed assets, we analyzed income, and now we're going to look at risk management. So what kind of risk management company is performing? So very important here is analyzing the level of bad loans. And remember, I mentioned you that when you're giving money away to somebody, you want to be sure that this money is going to go back to you, right? So same story here, and that's why in 2008, when U.S. banks were giving away mortgages nearly to the dogs, okay, or anyone who even people didn't have uh, any income at all, so they were giving mortgages to those people. They understood that these guys they're not going to repay them back. Those organizations which were giving this type of mortgages, they straight away try to sell them. They wouldn't hold these mortgages because they understand what kind of risks they have. But we as investors, we often don't know because banks they won't tell you if it is a bad loan or good loan, but they have to provide the statistics. And when you're going to look at this SEC filing report, you will see there how many loans they fail to collect. And usually they have this division, what loans they weren't repaid within next 90 days. So, for example, if person has to pay to like 1st of January and it's already April and person still didn't pay it, so they consider it to be a bad loan. Okay, so when delayed in payment. Now, Wells Fargo now has about 0.29% of bad loans, and they increased. They were last year, previous year 1.23, and now it's 1.29. So it's a bit more. Okay, so during crisis time, it was in a lot of companies was about 4, 5, and even higher percentage. And the higher percentage it was, the like the worst situation was for the bank because people didn't return their money. So what banks do now, they have to create a reserve for covering bad loans. So each time when they receive money from any loan, they have to put some money aside. So it's coverage of bad loans, and usually they put 2, 3 times higher than percentage for the loan. So I think Wells Fargo puts 1.5%. So if the total loan failure is 0.29 for Wells Fargo, and they put about 1.5. So they're actually covering 5 times of they create this reserve, which is pretty good, okay, for this particular case. So if those people don't pay the money back, and those guys who put deposits come to the bank and ask, okay, give me money back, they will be able to do that. Okay, bank wouldn't be in trouble. And of course, I explained already several times, shareholders' equity to total asset ratio. It is better to be if it is above 10%. Okay, so let's open few competitors and have a look at value line reports of competitors quickly.